Yeah, so here, this is my concern. This is 1998, and you had kind of a similar type of thing where we fell straight off a cliff, then we're coming up, and this, you have to be buying this market, right? You know, just like right now, you have to be buying it, but you want to be timid because the position of this, it just would be very unusual for it to just go straight up to new highs. So let's go out, you know, a week. All right, so at this point, it's starting to fail, right? Your 50-day is crossing down below your 200-day, which is your 50 is the red and the 200 is your black, and you're starting to roll over. So if that were to happen, you would be backing. You certainly wouldn't be increasing your positions. It's not a reason yet to completely bail out of that market, but you're being timid. Let's go out a few more days. The day after what we were talking about was your clear down day that you have to be completely out of that market. I mean, the market has failed. And even early on that day, you could just say that there's something wrong. And it's really, you're looking at that 50-day rolling through your 200-day. So with that, you have to be flexible. We had another follow through on there, and then we went straight up and never looked back. And this is what you guys should be doing at home with MarketSmith, is using the change date and training your eyes to what's normal. And let's flip back to the Nasdaq, and then we could be done with this history.
That's good.
So you can see how powerful this is, and this is why you don't, in fact, go out like 3 or 4 months. Why you don't want to sit there and say, okay, there's a follow through, and I'm going to wait for a pullback, because this was your classic case where it didn't pull back. So you do want to be, you know, as it's working, you want to be, you know, adding exposure, but also be aware of logical areas where it could fail. And so that never really slowed down. It just, you know, kept going.